Your spouse dies in March. Everyone around you says the same thing. Don't rush, don't touch the house, take your time. That advice, given with love, can quietly cost you $250,000. There's a rule buried in the tax code that most families never hear about until it's already too late to fix it. It hands a surviving spouse a 2-year window. Miss that window, and the tax break on your own home gets cut in half. Nobody sends a warning letter. Nobody calls to remind you. The clock just runs out in silence. Today, we're going to walk through exactly how this works, who it hits hardest, and what you can actually do about it while there's still time to act. Stick with me, because the dollar amounts here are bigger than most people expect, and the fix is simpler than you'd think. Let's start with a story. Call them Ray and Diane. They bought a small home outside Tucson back in 1981 for $58,000. Raised 2 kids there, paid off the mortgage years ago. Nothing fancy, just a house full of decades. Ray passed in early 2023. Diane wasn't ready to think about real estate. Her kids told her to take her time to heal first. So she did exactly that. Fast forward to this year, the house is worth $720,000. Arizona's housing market did that to a lot of quiet neighborhoods over the last several years. Diane finally sells. And here's where the story turns. If she'd sold while Ray was alive or within 2 years of his death, she could have excluded up to $500,000 of profit from capital gains tax, completely tax-free. But Diane sold 3 years after Ray passed. That window had already closed. Her exclusion dropped to $250,000. The result, tens of thousands of dollars in extra tax that a slightly different timeline would have avoided entirely. That's not a hypothetical horror story. That's simply how the rule is written. Let's break down why. Here's the mechanic, in plain English. The IRS lets homeowners exclude profit from selling their main home, up to $250,000 for a single filer, up to $500,000 for a married couple filing jointly. To qualify, you generally need to have owned and lived in the home for at least 2 of the last 5 years before the sale. When you're married and filing jointly, you get the larger number, $500,000. When your spouse dies, Congress built in a grace period. If you're the surviving spouse and you sell within 2 years of the date of death, you can still claim that full $500,000 tolerant exclusion, as though you were still filing jointly. That's a real legitimate provision, added to the tax code back in 2007. But it means exactly what it says, 2 years. Not whenever you're emotionally ready, not once probate finally wraps up. 2 years counted from the date printed on the death certificate. Cross that line and you fall back to the single filer exclusion of $250,000. If your home has appreciated significantly, and after the last several years a lot of homes have, that difference can mean real money out of your pocket at exactly the moment you can least afford to lose it. So why doesn't everyone already know this? Because it isn't really anyone's job to tell you. Your grief counselor isn't a tax advisor. Your real estate agent may not think to bring it up in the middle of a listing conversation. Even general tax preparers sometimes gloss over it because most of their clients aren't sitting on homes that have gained hundreds of thousands of dollars since the 1980s. It's not some grand conspiracy. It's simply a gap in communication. And gaps like this are exactly where ordinary families lose money they never knew was at risk. Now, here's a piece that makes this even more complicated. Where you live changes the math significantly. When a spouse dies, part or all of the home's tax basis can step up to its current market value. Basis is the number the IRS uses to calculate your profit when you eventually sell. In community property states, think Arizona, California, Texas, Nevada, Washington, and a handful of others, the entire home typically receives a full step-up in basis when one spouse passes. That can erase a huge chunk of the taxable gain right there, sometimes almost all of it. In the rest of the country, only the deceased spouse's half of the home gets stepped up. The surviving spouse's half keeps its original decades-old basis, so the tax problem shrinks, but it doesn't vanish. That's exactly where the 2-year exclusion window ends up mattering most. Same house, same gain, different zip code. Completely different tax bill. That's worth letting sink in. 2 families with nearly identical homes and nearly identical stories can end up tens of thousands of dollars apart, purely because of state lines and a calendar page. Let's put real numbers next to this, because vague warnings don't actually help anyone plan. Say a couple bought a home in Ohio in the early 1980s for $85,000, and over the decades put another $45,000 into a new roof, a kitchen remodel, and a furnace replacement. Their adjusted basis sits around $130,000. Fast forward to today, that home is worth $850,000. The paper gain is roughly $720,000. If both spouses are alive and sell together, they can exclude $500,000. Taxable gain, about $220,000. At long-term capital gains rates plus possible state tax, that's a real bill, but a manageable one. Now imagine one spouse passes and the survivor sells 3 years later, missing the window by even a few months. Ohio isn't a community property state, so only half the base is stepped up. The exclusion drops to $250,000 instead of $500,000. The extra tax owed, compared to selling within the window, can easily run into the tens of thousands of dollars. Same house, same family. The only real difference is a calendar page. Here's a second example, because seeing the pattern twice makes it click. A couple in North Carolina bought their home in 1990 for $110,000. It's worth $650,000 today. One spouse passes, the survivor sells 2 years, and 1 month later. That single extra month past the deadline can mean the difference between owing very little federal tax and owing tens of thousands more. 1 month. That's how unforgiving this rule is. So what do you actually do with this information? First, know your numbers now while you still can. Sit down, ideally with your spouse while you're both able to, and write down 3 things: the date you bought the home, what you paid for it, and every major capital improvement made since, with the year and roughly what it cost. This matters because capital improvements, a new roof, a kitchen remodel, an addition, a new HVAC system, actually increase your basis and reduce your future taxable gain. Routine repairs and maintenance don't count the same way. Getting this list together now, while memories and receipts are still findable, can save real money later. If you've lost some of the old receipts, don't panic. Building permits from your county, old contractor invoices, even bank statements showing large home-related payments can help reconstruct that history if you ever need it. Second, if you lose a spouse, get a professional date of death appraisal of the home. This should happen fairly soon after the loss. It's the document that establishes your new adjusted basis. Without it, proving what your home was actually worth on that date becomes much harder, and that can cost you at tax time. Third, mark the 2-year deadline the moment you have the death certificate in hand. Put it on a calendar, set a reminder. Give yourself a buffer, since real estate deals take time and closings often get delayed. If you want to preserve that full exclusion, aim to close well before the 2-year mark, not right up against it. Understand this too. The deadline doesn't pause for anything. It doesn't wait for probate to finish. It doesn't wait for family disagreements to settle. It doesn't care how ready you feel. It's simply 2 years from the date of death, full stop. Now, if you're watching this and the 2-year window has already closed for you, maybe your spouse passed a few years back and you're only hearing about this now, take a breath. You're not out of options. There are legitimate strategies that can still help reduce or spread out the tax hit. Structuring a sale as an installment sale under the tax code can spread the gain across multiple years, which can keep you in a lower bracket. Converting part of the property to a rental and exploring a like-kind exchange is another avenue some families use. A charitable remainder trust can convert built-up equity into a lifetime income stream while reducing the immediate tax bite. None of these are do-it-yourself moves. They require a CPA and often an estate attorney working together, but they exist, and a good specialist can walk you through which ones actually fit your situation. One more thing worth knowing: the $250,000 and $500,000 exclusion amounts haven't been adjusted for inflation since they were set back in 1997. Nearly 3 decades of home price growth, and those numbers haven't moved. That's not a conspiracy, just a fact worth knowing when you're planning around it. Here's the bigger picture underneath all of this. The tax code doesn't ask whether you're ready. It doesn't know about the memories built into that house, the years raised there, or how much selling it feels like losing one more piece of a life built together. It just runs on dates. That's not a reason to panic, it's a reason to plan. The families who come out ahead aren't the ones who skip grieving. They're the ones who put a few key facts on paper while they still can, so that when the hard day arrives, they're not making a 6-figure decision in the middle of the worst month of their life. If you're married right now, today is a good day to write down your purchase price, your improvement history, and talk with your spouse about what the plan would be if one of you had to sell alone. If you've already lost a spouse, check your calendar against the date on that death certificate. And either way, a conversation with a qualified CPA or estate attorney who understands this rule is worth far more than it costs. If this helped make sense of a confusing part of the tax code, share it with someone sitting on a home that's grown a lot in value, especially if they lost a spouse recently. It might be the most useful few minutes you send them all year. We'll keep breaking down the parts of the tax code that quietly affect retirees the most, the ones nobody explains until it's too late. Stay informed, talk to a real specialist about your specific situation, and don't let a deadline you never heard of make the decision for you.